Good afternoon, everyone, and thank you so much for joining us for our third presentation in our Wellness During COVID series. Today, we're going to be talking about financial wellness with this awesome presentation on How to Weather a Bear Market by Richard Appling from the NIH Federal Credit Union. So, before we get started, just a couple of housekeeping items. First, we will be sharing the slides from today's presentation after the training. Um, there is a post-training evaluation that we'd like you all to take a moment to complete. As soon as this presentation is over, it'll take you directly to the link for the evaluation, so please take a moment to fill that out. And for questions, if you have questions, we ask that you use the chat box, or if questions are asked for during the presentation, go ahead and unmute your phone and ask your questions directly to the presenter. And that is it. I'm going to actually go ahead and turn this over to you, Richard. Thank you so much for being with us today, and we're looking forward to this great talk.
All right, fantastic, Sharia. Thank you very much for that introduction. I'd like to take a moment as well, just to tell everyone about myself. My name, again, is Richard Appling. I am the Wealth Advisor for NIH Federal Credit Union. A little bit about NIH Federal Credit Union that I would like everyone to know is that we have a total of 8 branches. We have a location at the National Cancer Institute, NCI. We also have the Rockville location right by the courthouse. We have Fishers Lane. We have 2 locations on the campus of NIH, Building 31 and Building 10. We have Sibley Hospital. We have downtown Silver Spring. And we also have the Pennsylvania Avenue location. At this current moment right now, obviously because of COVID-19, we have 3 branches that are open. The 3 branches that are open are at Rockville, the location downtown Silver Spring, and the Penn Avenue branch. So updates will be coming, but I just wanted to make sure that I share that information. Next, as a wealth advisor for NIH Federal Credit Union, my area of expertise is retirement planning, retirement income planning, Social Security, and financial planning. So as a reminder, financial planning does come with your membership. If you are a member, we do a comprehensive financial plan for our members that digs into your current and future financial plans. So that does come with your membership, and I'll share with everyone at the end on how to take advantage of that. Okay, so with that said, I would like to start off with about today's topic, which is how to weather a bear market. How to weather a bear market. So, starting off there, if we can go. And the one next, one after that. All right, wonderful. So, the question is, there are, what is a bear market? So a bear market is a decline of at least 20% in a market index. And the market index that as advisors and the investment community, what we look at is the S&P 500, which is the top 500 companies in the United States. So for investors, this type of dramatic loss can be a highly emotional event. And when we're emotional, we often make decisions that don't line up with our long-term investment goals. So when was the last bear market? That's one question. How many bear markets have there been in the last century, right? And how often do bear markets occur? So can we go to the next slide? Okay, so what you're seeing is a chart of bear markets since 1900. So between 1900 and 2015, there have been a total of 32 bear markets, averaging when we look at a bear market, it's almost impossible to determine a bear market's bottom. Okay, a bear market's bottom. So, for example, when COVID-19 started and February, March, there was a major sellout of the financial markets. So, so we saw a lot of emotion happen and take out more than $1 trillion out of the market, just over a 30 to 45 day time span, and we're going to talk about that a little bit more. So, can we go to the next slide, please? So, one of the objectives, well, there are three objectives that we hope to achieve in this workshop, and that's understanding behavioral finance and the three keys to help weather a bear market. Next slide, please. So what is behavioral finance, right? What is behavioral finance? And we're going to talk about that. Next slide, please. So, assumptions. People gather all relevant information and make rational decisions based on that information. So decisions are based on really three things when we think about it, not just with our finances, but in general, how do we make decisions? Well, first, we need the data. We need the information. Next, we look at the analysis of it. And then third but not least, we look at self-interest. Is this investment right for me? What does the data show? What does the analysis of that data? And does this particular investment or this decision, is this in my best interest? So these are the three key components to decision making when we start looking at what our finances are. So next slide, please. Next slide. So behavioral finance covers what people are not always capable of making rational decisions. People make shortcuts that depart from their basic principles of probability. Psychological motives and biases impact people's behaviors. Emotions play a significant role in financial decisions, and investing isn't about competing with others. It's about controlling your emotions. So one of the conversations, many of the conversations that I had during February and March was clients calling and that panic of Richard, should I stay in? Richard, should I get out? I'm seeing drops in my portfolio. What do I do? And there was a lot of emotion behind that. And as an advisor, I help my clients understand that are we making decisions based off emotions, or are we still keeping the long-term goal ahead of us? Next slide. Next slide, please. So the question that you want to really ask yourself is, what does behavioral finance mean to you? Think about your own personal situations, everyone that is part of this seminar. What decisions did you make during the last 2 to 3 months and going forward? How successful are you in achieving your long-term financial goals and personal goals? And it really depends if you are a ostrich or a wolf, and I'll explain the difference between the two in a moment. Next slide, please. Next slide. Thank you. Next slide. All right. So when it comes to behavioral finance, we're looking at seven challenges that we internalize when we start talking about our investments. Some of these may resonate with the people on the call. One is overconfidence, right? Overconfidence is overestimating your own skill level. You attribute your success to your own ability to pick stocks, to get in, to get out, and so forth. Blind love. But blind love is where you have this particular stock or this particular strategy, and that it's worked for you in the past, and you're going to continue to do the same approach regardless of what the data and what the information is. Then we have selective memory. When something's up and you love this particular strategy or approach, but it's not doing well right now. We just remember when it was up. Then we have the overthinkers, where they're trying to time the market. Timing the market is not a good thing. We have loss aversion, where I'm not going to do anything. I'm just going to sit on the sideline, and I'm just going to wait for everything to blow over. I'm going to sell everything and take my loss and live for another day. We have short-term biases, but most importantly, we have what is called herding. We're seeing what the crowd does. We turn on the news and we look at what the talking heads on TV are saying. Everyone is selling, so that means I need to sell too. So we have that herding mentality, right? That herding mentality. Next page too, please. And you can actually continue to forward until slide 19. So how do we interpret market fluctuations? The brain forms an automatic and uncontrollable anticipation of another repetition. We think in straight lines, even when the market doesn't. The market does not operate in straight lines. So when we're faced with these challenges, we look at the market as it begins to fluctuate and our investment performance starts to move. So what if it's a bull market? What if there is an upswing? What do we do? Which way do we assume market performance will go? Will it stay up, stay the same? Will it go down? Our straight line thinking means we believe it's going to continue to go up, and that's not always the case. Next slide, please. Next slide. Yes, thank you. So the role of the media in a bear market. So when you turn on the news, you have news cycles and social media outlets. They play an important role. When markets start to fall, the pressure on investors usually begins here. The start of negative cycle negative cycle, that's where we start to look at our investments, and we start to have that flight or fight type of mentality. So we probably always we have all been there, where we get our statement in the mail and balances are down, or if you're at the water cooler or at a friend's house, and you get influenced by comments like "I'm staying out of the market." So these are the type of conversations that really weigh on you when you start talking about behavioral finance and the type of decisions that you make. Next slide, please. It can be a emotional roller coaster, right? So can you hit next slide, and the graph will start to fill in. If you can continue to do that. And perfect, one more time. One more time. Perfect. Okay. So the emotional roller coaster, where we have overconfidence, when we start making uneducated decisions, we buy more. We have that blind love that we talked about. We keep on buying. We have loss aversion. Hey, I'm getting completely out, right? Sell everything. Fear of volatility, where you just stay in cash. You move everything to cash. And you have short-term biases. You start buying again. So this emotional roller coaster, is all driven by our fear of loss, where we don't want to make a bad decision. Next slide. And if you can do the same thing where you, correct, thank you. Okay, so in February, March, and April, and even today, the conversations that I'm having with clients, with members is, yes, you want to be cautious. These are educated type of decisions. You want to be disciplined. You want to be patient about your approach. Remember the long-term goal. You want to be savvy. Right now, the market is on sale, right? That's where investors are they're taking advantage of those opportunities where they can start buying, right? Energize, you end up buying more. You hit enter one more time. Hit next one more time. And last but not least, you're still cautious. So I don't want to give the impression that you shouldn't have any emotions, but you want to have educated decisions that are driving your emotions with your investments. Okay. Next slide, please. And okay. So is there a difference between good and bad investment decisions? Yes, they are. A study has shown that they looked at the annual performance of the S&P 500. That's the index that tracks the top 500 U.S. stocks and is generally considered a general representation of the overall market. For 2016, the S&P 500 had a strong bull market year, returning 11.97%. Then we compare that to the annual return of the average equity mutual fund, right? Mutual fund, you can expect it to be similar, you would think. The average investor saw a return on their stock funds of only 7.26%. The typical investor underperformed the S&P 500 by 4.7%. Why? It's all those behaviors that we just talked about. It's the loss aversion, short-term biases, hurting. People get in and out of the markets at the wrong time, and that leads to the underperformance. This year wasn't a fluke. If you look at the 20 years of the annualized returns of the S&P 500, there's a gap of almost 3% between what the market delivered and what the average investor received. Through the ups and downs of market cycles, emotional investing can take a toll. So the point being is that the S&P 500 represents the top 500 companies in the U.S., and it's a passive strategy. So there is no buying, there's no selling, there's no getting in, no getting out. The S&P 500 is just a true representation of what the top 500 companies in the U.S. So if someone owned a S&P 500 index, which is a passive approach, then their investment portfolio during this time frame would have earned almost 12% versus a mutual fund approach where that is driven by emotions by the individual investor. There's a lot of getting in and getting out, plus the fees. You see that the difference in return can be substantial. Next page, please. Well, what can we do about these natural tendencies, these natural human tendencies? As an advisor, I remind clients of the benefits and opportunities. As your advisor is supposed to also help educate you on proven investment techniques and uncover new strategies and ideas. Next page, next, please. So when we look at bear markets, we have good decisions and we have bad decisions. And can you hit next for me? And again. And two more times. All right. So, oh, sorry, go back. I wanted to. There we go. Perfect. Okay. So when you get hit with a bear market, the very first question you want to ask yourself is, okay, am I being emotionally driven by my financial decisions? The decision you're about to make with your investments, with your money, stop and ask yourself, is this an emotional decision or is this a logical one that's based on the data, on the analysis and the facts, right? Review your goals and the facts. What are your goals, right? If the goal is for this money to continue to grow and create an income for you, then we want to keep the long-term goal ahead of us, not to make decisions on short-term goals. For example, at the beginning of the year, in January, the S&P 500 was at 3,200 points. Just to give you an example, 3,200 points. When COVID-19 hit, and between February and March, it had dropped all the way down to like 2,200 points. So it lost a good 20% of its value. Today, as we're sitting here, the S&P 500 is at 2998. It's almost back up to 3,000 points. So for my investors that panicked and they sold, those were real losses that they took on their portfolios. For the investors that weathered the storm and remembered their long-term goals, their portfolio has rebounded, not to its full original value, not at this point right now, but they did not take a 20% loss. They are only down 2 or 3% in their portfolio if they were carrying mostly of the S&P 500 companies in their portfolio. And I'll be more than happy to do a analysis and review for anyone after the call of their portfolio to see where they're at. But this is just an example of how to weather a bear market. Next slide, please. So when we understand our emotions, we find that we can react differently to the same situation that might have caused us problems in the past. Again, it's just a reminder of, before we make a decision financially, is this emotional? Is this being driven by emotions or by data, analysis, the facts, and so forth? Can you hit next, please? All right. A few slides ago, I mentioned ostriches and wolves. So ostrich behavior is the behavior of ignoring the media storm, overreacting. You do absolutely nothing. You kind of put your head in the sand. You sell everything. You start over. Again, all these decisions are emotionally driven, with trying to avoid and not make a bad decision, and you end up actually making a bad decision. Next slide, please. Wolves. They do some very similar things as well, but what wolves do, they react to bear markets the same way. They pounce, they blame, they ask questions later. You also overreact, say everything, start over again. So we want to avoid the ostrich and the wolf behavior, and really concentrate on making sound decisions that are based on, again, the facts, analysis, data, and so forth. Next slide, please. Again, as you should be having this conversation with your advisor. If you would like to sit with me and I can do an analysis for you, one of the very first things that your advisor should be doing with you, that I do with all my clients, my members, is that, what are your long-term goals? How has the portfolio performed over the long term, right? In light of the current markets, does my current strategy still make sense? This is a very important point right there. I can't emphasize this harder, is that when it comes to making sure that you have the right strategy, and that's where doing a financial plan, if you're a member of the credit union, it comes with your membership, where that you want to look at your strategy and see if it still makes sense. Is it outdated? Or is there any improvements to the strategy that you can do? And what, if any, changes should you make? Those are the type of conversations that you want to be having with your advisor when it comes to making those type of decisions. Next slide, please. So, leveraging proven strategies and new products. The financial industry looks completely different, the landscape, of products and services and strategies look completely different from 5 years ago, from 10 years ago. The investment community, investors, have been asking for change. They've been asking for new strategies, new approaches, and there are new strategies. There are new approaches that are out there for investors to take advantage of. However, one of the missed opportunities for long-term investors that are in their 50s, 60s, and 70s is that this is the way that they've always invested. That when you start to look at the new and improved strategies that are out there on the market, you will be surprised, and it will help you greatly to and through retirement if you have an opportunity to sit down and look at what these new strategies are to help you achieve your goals. And if your advisor is not talking to you about these type of strategies or new products that are out there to help weather these type of storms that we're experiencing now, you know, that's a conversation that you definitely want to have. I can have that with you as well as the advisor for the credit union, but having a plan that is built on a strategy with new products and services is something that is really going to help you. Next slide, please. So, 3 keys to help weather a bear market. Next slide. Number 1, you want to conduct a complete asset allocation review. Asset allocation. How much money do you have in the market that is exposed to all the upside and all the downside? How much guaranteed allocation do you have set up? Guaranteed. Guaranteed outcomes are built around annuities where that you may not get all the upside of the market, but you have a downside protection where that if the market drops 20%, you're not exposed to that whole 20%, but you have a guarantee built into your strategy of income that you can never outlive. That's part of asset allocation. How much money do you have sitting in cash? How much money do you have sitting in alternative investments? Doing a complete review of your asset allocation will give you more information to make better decisions. Number 2, consider investments that offer growth potential and downside protection. Again, there are new strategies, new products that they're out on the market that will give you growth, but also downside protection to help limit losses and guaranteed income, right? And write your own My Bear Market plan, your own bear market plan. Next slide, please.
Actually, Richard, we have a couple of questions online.
Sure.
So can we take a moment to get some questions? All right. So I see that we had one from A. Kenny. I'm going to unmute your phone so you can ask your question now. A. Kenny, you can go ahead.
Hello?
Yes.
I was just wondering if these slides would be made available after the presentation as well for future reference.
Oh, yes, absolutely. We will be sharing the slides after today's presentation. Okay.
Sure.
No problem. Thank you. All right. The next question is from Darrell Scott. Darrell, I'm unmuting your phone or your line so you can go ahead and ask your question.
Oh, thank you. Hi there. Yes, that was informative. Certainly everyone has been impacted by COVID-19, and the question seems to be your money from your weekly pay goes into your 401k, and then is it disappearing into the ether when the market tanks? I think this was outlining some of the perspectives that we have. I'm not sure if I better understand what my decisions should be. I think I actually had some other questions in reference to debt, but perhaps that's something for offline.
Absolutely, yes. I'll share my contact information at the end, and I'm open for emails and phone calls and web access that I've been doing one-on-one with members and clients to answer more specific questions. So for your thrift savings plan, 401k, the question is, hey, you know, should I continue to contribute, and you know, is my money just disappearing into the ether? Am I just throwing money away? And the answer to that question is, it depends on what your asset allocation is. When the market starts to fall into that bear market, the flight of money goes towards safety. So safety, number one, is cash. That's everyone trying to sell out and, you know, go into cash and sit on the sidelines, or they go over to bonds. Bonds represent debt. So, and that the biggest borrower is the U.S. government. So they go into government bonds, right? So government bonds, they don't give you a lot of yield, but they don't have a lot of fluctuation and volatility. If you have a portfolio that is built around the S&P 500, that's where the market is going to recover, is within that S&P 500, the top 500 companies. As I stated at the beginning of the year, the S&P 500 was at 3,200 points. In February and March, it dropped all the way down to 2,200, and it lost 20 to 25% of its value. So, and today, looking at it, it's knocking on the door of 3,000. So that's where that buy and hold, stay the course, remember what your goals are, strategy comes into play. So what I would recommend is that as a investor, if you have a 401k, you have a TSP, you want to look at what your asset allocation is. You want to look at what fund you're in. Are you in the G fund? Are you in the I fund, the L fund? Are you diversified, right? The bad decision is to move everything over to an ultra conservative portfolio, and you miss the rebound. So when 2008 hit, that's where a lot of investors did exactly what they did back in February, March, is they went so conservative. They forgot they went so conservative. Then when 10 years went by, they looked at their account. They were like, well, how come I don't have any? I don't have more in there. Hearing the market is up, 20 and, 15, 20%. They never went back to change the allocations. They never got that rebound. So, to answer your question, I would first recommend a one-on-one. Let's look at your allocation. Let's look at how you're diversified, and we'll build off that.
That sounds great. That's a great reply. Yes, contact info would be great. Thank you.
Thank you so much. So, Richard, we have about 7 minutes left. So, did you want to maybe do your last slide or two, and then we can just give an opportunity for more folks to ask questions either here in the chat box, or folks, you can raise your hand and we'll make sure we acknowledge your questions on the call. Does that sound good?
Sure. Yep.
Okay.
Sounds good. Next slide.
Mhm.
All right. So bear markets, they can shift your portfolio to what I call being out of balance. And what that means is that out of balance, they really undermine your long-term goals. So that's why it's important to sit down, evaluate, and look at your asset allocation. So let's go to the next slide.
Okay, and we did actually get a question. Do life cycle funds provide leverage during a bear market?
So when you start talking about those life cycle or those target type of funds, those funds will automatically adjust their asset allocation based on your retirement age that you put into the strategy. So if I have a retirement or target fund that is 20 years from now, my asset allocation is going to be more aggressive, meaning more equities. And as I get older, or when I get halfway there, then it goes more 50-50, bonds to stock. Then when I get closer, it'll be more, you probably end up like at 80% bonds, 10% stocks, and 10% sitting in cash. So to answer your question, those are passive strategies where those strategies are set on autopilot and they adjust based on where you are in your plan. So in regards to like COVID-19 and a strategy like that, again, I don't know your individual specific situation. I don't know if your target fund is how it's weighted. So that's where doing an asset allocation review of your portfolio makes sense, because I don't know enough about your individual situation to really comment on. But generally speaking, that particular life cycle target fund will adjust based on your age, on when you're planning to retire. And I'll be more than happy to go in deeper with you, whoever asked that question. I'll provide my contact information and we can get more specific. So how do you do a asset allocation review? Number one, list all the places where you have your investments, both retirement and non-retirement money. Step two, you want to list the investments you own at each institution and their current value. That includes checking, savings, CDs. That's part of your asset allocation. Three, we want to analyze the allocation of all the investments in light of your long-term goals and risk tolerance. So that's for the clients, the members that want to take advantage of the financial planning that we provide to our members at no additional cost. It's very comprehensive. It's very specific to the individual. It's done by our certified financial planner and also our analysts. So you get real-time professional review of your individual portfolio. Last but not least, we rebalance as necessary. So we'll make recommendations and changes to the portfolio as it makes sense. Next slide, please. So for the sake of time, let's just go down to the last page, 43. And we'll make sure we get the slides out to you, and also I'll get a worksheet out to everyone about that. So my contact information is up on the screen. My direct office number is 301-296-0643. My mobile number is 240-462-2380. My email is richard.appling@cunamutual.com. And the way that I am meeting and helping clients is via WebEx, where I will send you an invite. I'll be able to share my screen. We'll be able to conduct a appointment, a meeting as if I was right in front of you.
All right, we do have another question. If you are planning for the long term, would rebalancing your asset allocation during a bear market lead to the possibility of short-term mistakes?
Well, that's a great question, and it depends. I don't know enough about the person who asked the question about their existing portfolio. So, for example, if that person's allocation is heavily weighted toward fixed income and bonds, then that portfolio isn't positioned to take advantage of the market rebound. So, because right now, the way you want to think about it is the market is on sale. So you're getting high quality companies at lower prices. So there's nothing wrong with the company. They have strong fundamentals. They have a strong track record earnings. For example, all the major top 500 companies like Google and Facebook and Apple and so forth, all those companies in March were on sale because they were affected just like everyone else in regards to selling. So, so if you tell me today that at the beginning of the year Apple was $250 a share and it dropped down to $200, and getting in at $200, knowing that it's a great company, and now their price is back up, you know, that is an individual stock, you know, opportunity, but they're part of the S&P 500. So there are a lot of top companies that would have benefit, you know, from that. So to answer your question, I don't know enough about your individual situation. That's why with my contact information, you can reach out. I can take a look at your portfolio and give you a more decisive answer.
Thank you so much, Richard, for all of this really good information. And I do hope for those of you calling that you do take advantage of these resources. And if you haven't considered the Federal Credit Union, just generally speaking, you can go ahead and check out their website and all of the services that they provide. So I just want to thank everyone for joining us this afternoon for this series, this session of our Wellness During COVID training series. And again, we look forward to seeing your responses to the evaluation. Please share the topics that you'd like to hear about because we want to continue to bring you meaningful and helpful presentations. And again, Richard, thank you so much for such a great talk. We really appreciate you. And everyone,
Thank
you
you.
guys enjoy the rest of your afternoon. Thanks so much.